Today, we will talk about how to build a high-yield dividend portfolio. Building a high-yield dividend portfolio is a financial strategy that offers the potential for a steady stream of income, making it particularly attractive for those seeking to supplement their earnings, save for retirement, or generate passive income. Such a portfolio is designed to provide investors with dividends from a diverse set of income-generating assets, which can include dividend-paying stocks, bonds, real estate investment trusts, REITs, and more. In this guide, we will explore the essential steps and insights required to construct a high-yield dividend portfolio effectively. Whether you are a seasoned investor looking to enhance your income or someone new to the world of investing, this content will provide you with the knowledge and tools to embark on the journey of building a high-yield dividend portfolio that aligns with your financial goals and risk tolerance. From asset selection and risk management to the importance of reinvestment and tax considerations, we'll delve into the key strategies and considerations that can help you create a reliable and sustainable source of income through dividend investments. However, it's essential to approach this strategy with careful planning and a long-term perspective. Here's a step-by-step guide to help you build a high-yield dividend portfolio. First one, assess your financial goals and risk tolerance. Before you begin building your high-yield dividend portfolio, assess your financial objectives, such as the level of income you need, and your risk tolerance. Understanding these aspects will help you determine the right approach and asset allocation for your portfolio. Second one, asset allocation. Decide on the mix of assets in your portfolio. Common income-generating assets include stocks, bonds, real estate investment trusts, REITs, and dividend-paying mutual funds or ETFs. Your allocation should align with your financial goals and risk tolerance. Third one, selecting dividend stocks. When selecting dividend stocks, consider the following factors. Number 1, dividend yield. Dividend yield is a crucial financial metric for investors, especially those seeking income from their investments. It's a ratio that indicates the annual dividend income you can expect to receive from an investment, expressed as a percentage of the investment's current market price. Number 2, dividend history. Dividend history is a critical aspect to consider when evaluating dividend-paying stocks or investments. It provides valuable information about a company's track record of distributing dividends to its shareholders. Number 3, payout ratio. The payout ratio is a financial metric that indicates the proportion of a company's earnings that it pays out to shareholders in the form of dividends. It is a critical tool for investors when assessing a company's dividend sustainability and growth potential. Number 4, financial health. Financial health is a term used to describe the overall financial well-being and stability of an individual, business, or organization. It involves assessing a wide range of financial factors to determine their ability to meet financial obligations, achieve financial goals, and weather economic challenges. Number 5, industry and sector diversification. Diversify across industries to reduce risk. Number 7, dividend growth versus high yield. Consider whether you prioritize current high yield or long-term dividend growth. Some companies offer substantial current yield, while others may have a lower yield but a history of increasing dividends. Balancing both can be a wise approach. Number 7, reinvest dividends. Consider reinvesting your dividends, especially when your portfolio is in its growth phase. This can lead to compounding and significantly increase your income over time. Number 8, risk management. Be aware that high-yield investments often come with higher risks. Evaluate the potential risks associated with each investment and ensure they align with your risk tolerance. Diversify to mitigate risk. Number 9, tax considerations. Be mindful of the tax implications of your dividend income. In some countries, qualified dividends receive favorable tax treatment, while others may tax them at a higher rate. Use tax-efficient accounts to minimize tax impact. Number 11, regular monitoring and rebalancing. Continuously monitor your portfolio's performance. Rebalance your portfolio when necessary to maintain your desired asset allocation. Selling investments that have appreciated significantly can help you lock in gains and rebalance into underperforming assets. Number 12. Emergency fund. Ensure you have an emergency fund outside of your investment portfolio. This fund can cover unexpected expenses and prevent you from selling investments prematurely. Number 13. Professional guidance. If you're unsure about managing your portfolio, consider consulting a financial advisor or using robo-advisors that specialize in income portfolios. Number 14. Patience and long-term perspective. Building a high-yield dividend portfolio is typically a long-term strategy. It may take several years to achieve your desired income level. Maintain discipline, and avoid making impulsive decisions based on short-term market fluctuations. Number 15. Consider alternative income sources. While dividends can be a substantial source of income, explore other income-generating opportunities such as rental income from real estate investments, peer-to-peer lending, or income from other alternative assets. Building a high-yield dividend portfolio is a dynamic process that requires continuous attention and adjustment. As you gain more experience and your financial situation changes, you can fine-tune your portfolio to better align with your evolving goals and risk tolerance. Always remember that investing in the stock market involves risks, and past performance is not indicative of future results. So conducting thorough research and maintaining a diversified portfolio is crucial.